You're listening to Ron Siegel's Home and Finance Radio Show, only on Financial News and Talk. Now live in studio, your host, local and national real estate expert and consumer advocate, Ron Siegel.
And hello again. Welcome to Ron Siegel Radio. This is the show with no real boundaries as we discuss current events, financial markets, politics, sports, even poking fun at the rest of the media. This is the show that connects the dots of confusion delivered by conflicting media reports. We connect the dots so you know the actions you can take, how your family or business can benefit from current events. Most of all, thank you for joining me. Within every market, there are solutions as well as tremendous opportunities. You just need some trusted guidance. That is my message, and I will be delivering it every day. We have a very focused show. We only chat about items that affect the roof over your head, your bank account, and anything I feel would benefit you. But before we get into our intriguing content today, please join me in welcoming our featured guest. Todd Halterman is with us. Look at that picture behind you, Todd. Is that a fake background or is that real?
Yeah, that is my virtual friend right now.
That's your virtual friend. Okay.
I just moved offices and my wall is plain white with nothing on it.
I was going to say that's a nice looking. I was going to say that's a nice looking. I know you're out there probably somewhere at some beach or resort or some part of the world that's exotic and faraway places.
Yeah,
escaping the formerly Golden State. But let me remind you, if you ever have any more finance-related questions, I am the consumer advocate looking out for you, and you can reach out to me directly, 800-306-1990, 800-306-1990, or ronsiegelradio.com. Just remember, that's the number you call anytime for assistance. When you call that number, it comes directly to me first. There are operators standing by.
Quiet, numbskulls, I'm broadcasting.
While I do have a great team when it comes to developing a financing plan, a plan to save you money, I personally work with you. Even if you don't have any needs today, save this number in your phone for future reference, 800-306-1990, 800-306-1990. And yes, of course, we are celebrating today. I don't know, yesterday was National Sticky Bun Day. I didn't even get a chance to go out and I didn't go out and get any sticky buns. Maybe somebody else did. I'm not going to go there, but because it only caused me trouble. National Supermarket Employee Day. That doesn't sound very exciting. Cook a Sweet Potato Day. Cook a Sweet Potato Day. I think Josh might be locked up on me there because he usually puts that picture right out there. Now, hey, guys, let me ask this question because I've got my own personal preference, sweet potatoes. Now, there used to be I think it used to be Lucille's or it might have been another barbecue place that they make the sweet potatoes and they've got a cinnamon and brown sugar butter sauce that goes on top of them. Sounds good to me, but you know, that's... Of course, then again, my doctor doesn't seem to like that one for me too much. But if I had it with a margarita, then that would be okay, right? Because the alcohol content might break through the margarita portion there. Sounds good to me. I like either way. So National Cook a Sweet Potato Day and Margarita Day. We've got both of them for you today. Love them both. Where are you going for the best margaritas? That's the question. I'm not a tequila guy other than Comisario Tequila. We did have them on the broadcast, so I do like Comisario Tequila. You know, maybe if I tried more tequilas, I'd like it, but that Comisario, that's good stuff. Hey, let's take a look at what the markets are doing today. The Dow Jones Industrial Average down 264 points. The S&P 500 down 23. NASDAQ down 123. We're going to talk about that and why that's happening. Oil prices, a barrel of oil up $1.64 right now. Let's see. Okay, Lori, our tremendous underwriter, $3.31 a gallon she's still paying. Jody, our newest team member, welcome to the team, Jody, $3.71. Josh, you're at $3.95.5. You're quickly moving up to that $4 price where we are right here in California. Todd, you in Washington or Idaho today?
I'm in Washington today.
Okay, so you're 398. So you're a little bit ahead of Josh. But hey, I am still the winner, if you want to call it the winner.
The California King.
Yeah, we're in California. We're at $4.74 a gallon on average.
Ow!
Yes, that is painful. That's where we are price-wise right here in the formerly Golden State. County of Orange, we're at $4.76. I think I paid $4.74 for premium at Costco over the weekend. Painful, not something that I'm proud of, but we are in the formerly Golden State, so we don't have a choice. We like to tax, and if it doesn't move, tax it. Checking the markets a little bit. How about this? The rental increases. Now, if you're an investor, I know the markets are volatile, and Todd and I are going to chat about that today, but top 10 markets for rent increases in the month of January. You ready for this one? You better hold your chair on some of these because they might get a little bit painful right here, right now. Realtor.com is our source for this information. Miami, up 52.4%, 52.4. Tampa, 37.5%.
Wow.
Orlando, 34.8%. Jacksonville, 32.1%. San Diego, 31.5%. Austin, Texas, 31%. Las Vegas, Josh, rents are up 30% in Vegas, 27.1% in Phoenix, 26.5% in Memphis, and Riverside, California. People are dying to move to Riverside, California. The rents are up 25.2%.
Ow!
Are you still thinking about renting? Are you thinking about buying a house maybe right now? Well, interest rates are going up as well. So we're going to watch all of that. But here's the issue, and here's, frequently I will talk about various subject matter in our opening monologue. But I've been involved in the markets since about 80. Well, actually, I started investing in the markets in the mid 70s. Yes, I was young, and I got to invest through my parents' holdings because I might have been a little younger than I was supposed to for direct investment. But back then, you couldn't really make any direct investments. You had to call a broker. You couldn't go online. Al Gore had not invented the internet by that point. We actually had to go to the newspaper. You couldn't fold the Sunday paper in half. And you had to go to the newspaper to figure out what was going on in the stock market. Well, you don't have to do that right now. We've got all of that at our fingertips. But we've also got world news at our fingertips. And this is something that I want to share with you today. And Todd and I are going to chat about it. Got a lot of, you can watch the markets. You can say, okay, Home Depot didn't come out with the greatest report in the world. So they're driving the Dow Jones Industrial Average down this morning. Or at least the last time I looked. I haven't looked at it in the last little bit. Yeah, down about 9% this morning. Okay. So we know that that's about 100 points on the Dow, just as attributed to Home Depot. And when you have a market mover where earnings, okay, we understand that. The thing that we can't understand, we can't predict is geopolitical events. What's going on in Russia, what's going on in Ukraine. The one thing I can guarantee you, and we don't guarantee a whole heck of a lot on Ron Siegel Radio, and when it comes to the markets, we guarantee even less. The markets will overreact. It always overreacts. But when you've got events like this, we looked at, last night I actually looked at the Dow Jones futures. And overnight, they were down about over 600 points on the futures. Then they open up down about 190 points. Now they're down 280. Very, very volatile. So from a 30,000-foot level, we're not going to put Todd on the spot. We're not going to ask him for any predictions. We're not going to ask for any guarantees. We don't even want to know what he's buying or not buying, what he's telling his clients to buy or not buy. What we want to know from a very high level, Todd, is do we do anything on a day like this? Or do we just kind of sit back and if we own a good company, stay in the good company? If we own a bad company, we might want to adjust. We might want to put money to work. What do we do when there's got this ultra volatility?
Well, you really need to have a plan in mind before you even get to this volatility. So I hate to sound, soapboxish, but this is why people make plans so they know how to react and how to respond in this type of an environment. There's a difference between investors and traders. Traders in this market are looking for opportunities to sell or to sell short and try to predict which company, like Home Depot, who reports earnings over their estimates. Their sales grew 11% in the fourth quarter of last year, and they expect single-digit growth this year. So Wall Street, for some reason today, just doesn't like that they're profitable. I don't understand the decline other than supply and demand indicators show a slowing of profits at Home Depot. But it's really weird day to see a profitable company announce and have such a hit to their balance sheet. So in my opinion, you're looking for economies of scale. You want to be buying companies today that have large moats. A large moat means they can sustain their marketplace and market penetration with their brand and their industry dominance. And they've got a lot of cash on hand. So ride the storm. Sudden economic changes come back very quickly in most cases. And right now is the time to stick with your plan and not blink. These are small, bouncy rides. The second half this year is looking very, very positive, and there's a lot of strong fundamental indicators showing that.
Great information, and that's a key. Now we're gonna talk more about this with Todd when we come back. But if you get a good company that's on sale, that's what's called Home Depot today. Maybe you want to look at your portfolio and see if that makes sense. You're listening to Ron Siegel Radio, discussing your real estate, current events, and the financial markets. When we come back with Todd Halterman, we're going to chat about a plan to be out of debt in 10 to 12 years. We'll talk about it, the perks of owning more than one home. We'll talk about that, when and how to cash out of life insurance. Should we? We'll talk about that as well. You can reach me anytime. Our off-air number, 800-306-1990, 800-306-1990, or RonSiegelRadio.com. Facebook.com/Ron Siegel Radio. And if you miss any part of our broadcast, Ron Siegel 1 on YouTube. Ron Siegel, the numeral 1 on YouTube. Stay tuned. We'll be back in just a few.
Ron Siegel Radio, your home and mortgage connection.
Are you paying rent because you cannot afford to live in your dream home? Are you paying rent because you don't believe you have the down payment funds to purchase your own home? At Siegel Lending Team at RonIsMyLender.com has up to $25,000 to help qualified people purchase their own home at amazing interest rates. Contact the Siegel Lending Team today at RonIsMyLender.com. Again, RonIsMyLender.com. Licensed under NMLS 217037. RonIsMyLender.com.
Are you earning a safe, secure 10+% return on your investments? Is your credit score over 800? Are you living in the home of your dreams or simply where you think you can afford? If the answer to any of these questions is no, what are you doing about it? Text ATP to 79564. Complete a 3-minute complimentary survey, and the area trusted professionals of Ron Siegel Radio will reach out to you to develop a success strategy for you. Again, all you need to do is text ATP to 79564.
You're listening to Ron Siegel's Home and Finance Show with local and national expert Ron Siegel. Now, here's Ron.
Welcome back to Ron Siegel Radio. Within every market, there are solutions as well as tremendous opportunities. You just need some trusted guidance. That is my message, and I will be delivering it every day on Ron Siegel Radio or anytime at 800-306-1990. 800-306-1990. Dow Jones now down 317 points. The NASDAQ is down 158 points. The S&P 500 down 3274. 10-year Treasury is up. Fascinating. Mortgage-backed securities, the bond itself is down. Again, that's another fascinating story because the bond market is talking to us, and usually, not always, but generally the rule of thumb or the thought process is the bond market is smarter than the stock market. We'll talk about that in a second here. Why are these things happening? Case-Shiller Home Price Index tracks the changes in the value of residential real estate across the U.S., was reported for the month of December. The national index, which covers all 9 U.S. Census divisions, reported an 18.8% annual gain in December, remaining flat from the prior month. FHFA, Federal Housing Finance Agency, House Price Index, measures home price appreciation on single-family homes with conforming loan limits, increased by 1.2% in December, which was above the expectations of 1%, remained flat from the previous year of 17.6% year over year. Massive numbers on real estate, especially when you take into account the fact that you've got leverage on real estate. You don't have that on so many other areas. Top 3 performing cities: Phoenix up 33%, Tampa up 29%, Miami up 27%, San Diego monthly up 1.8%. Moving right along. A lot of growth here in all these different areas. And why did I say that the bond market is talking to us a bit different than the stock market? Remember, bonds, the price goes the opposite direction of the yield. So if the bond goes up, the yield goes down. Now, the 10-year Treasury, the yield is up 4, which means the bond is down just a little bit. Why would the bond be down when you've got geopolitical issues going on? And you would think that money would be flow. If the world was worried about what's going on in Russia and Ukraine, what would they be doing? They'd be buying a lot of bonds. Buying a lot of bonds means there's more demand for the bond, which would then bring the price up, yield down. That's not happening. So maybe the bond market doesn't see things quite the same way as some of the news is seeing. That's the Mortgage Minute, brought to you by our friends at Geneva Financial. When you're ready for that next home loan, Geneva's got the programs and the products. You just need to make the call, 800-306-1990, 800-306-1990. Operators are standing by. Let's chat this morning. Todd Halterman is with us. He is a guru in the world of finance. He talks to, comes up with, and it's about planning. And Todd, in the last segment, you brought this up, and we were running late. Producers probably were not even happy that I started that discussion that late into the segment. But hey, you know something? It's live radio, so we do different things, and we makes our lives more entertaining for the producers too. But the concept here is that the bond market's telling us something different than what we're hearing in the news. Am I right, or am I misinterpreting this?
Yeah, the behavior of the market right now is irrational based on banking standards, Fed policies, and of course a little bit of noise of overseas issues. But the overall bond market doesn't seem to be buying this Russian noise.
Okay, so those of you that were thinking that we're going to get a big drop in interest rates because of it, maybe not. Now, the inflation is still here. Do you think inflation's going away, Todd?
Systemic inflation is going to maintain itself right now, and I think we'll find the Fed to stick with their interest rate bumps. They may skip 1 month, but we're going to see a couple more bumps between now and July for sure.
Now, one of the Fed presidents is saying, 5 bumps, 7 bumps, something like that. I think Bullard is about as hawkish as they get. But the market's saying we're going to for sure have a rate increase in March. I think that's built in, isn't it?
It looks like it to me. I was in some economic summits last week, and a lot of people that are way smarter than you and I were talking that we're going to see it for sure. That it could be a timing issue, but March looks like a lock for a quarter point.
Okay. So we know where that's going. Now that does not affect directly mortgage-backed securities. The Federal Reserve is dealing with their discount rate. Now, the discount rate does drive prime rate, which drives home equity lines of credit. Most of those are a margin above the prime rate index. So that's going to have an effect there. So if you haven't looked into getting out of that home equity line of credit and you've had 30% appreciation over the last 2 years, might be a good time to think about that. But the focus of it really needs to be, and that's why I'm really excited to talk to Todd Halterman, is you're already making that payment now. And yes, your mortgage, your first mortgage likely will increase when you go to refinance that. But your debt service of your household is what's more important. Your blended household interest rate. And I've shared this with you before. Visit rsrnodebt.com, rsrnodebt.com, And our team will figure out what your blended household interest rate is for you. So you don't have to worry about that. That's weighting all of the interest rates. But now what we're going to talk to Todd about is, what if we keep spending that same amount of money? Can we redeploy that money in a better way, Todd?
You know, it's funny because this tax time, everybody thinks about going to their CPA to get taxes done. But frankly, Ron, you and I could get the worksheet out, follow the instruction booklet, and probably do our own taxes. Why don't we?
I don't study it as much as my accountant does.
Yeah, they do know some things that we don't. So actuarial scientists, people that have a scientific degree and doctorates in math, actually look at people's budgets today, the way they're paying them, and then they work numbers and magic on paper, and the actuaries come back and tell people, well, this is how we would pay your bills differently. So without spending any more money than they're spending right now, these actuaries are helping people get out of debt in 9 years or less.
9 years. That just sounds like, I hear those things and you wonder, okay, do I have to get a 10-year mortgage, which I can't afford, especially in Southern California? I can't even afford a 15-year mortgage, is what most people tell me in Southern California. They don't qualify for it. And personally, I don't like them, because I look at a 10 or 15-year mortgage, and what happens if we get another Delta, Omicron, whatever the next fabrication is of the virus? And we have tough times. People do have tough times. Do I want to be locked into a high payment? But again, maybe there's a better way from these actuarials to get that 9-year plan that you're talking about, Todd. Do I have to go to a 10-year mortgage?
No, really what happens, Ron, is that there's families out there that'll pay $50 to $100 a month extra on their credit card, maybe $100 a month extra on the automobile. They'll throw a couple $100 a month extra on their mortgage to try to pay those off ahead. And generally, when you're doing that, it's absolutely correct to do that, but there's more of a structured way that actuarials will approach it. The actuaries actually help families create their own type of bank account and show them how to compound that money tax-free to get out of debt in 9 years or less. And it really is moving money on a paper and helping teach them, instead of putting 50 there, and 100 there, we group it together, and we really do build a small bank for people.
So why do I want a small bank? I mean, is that going to help me get out of debt? What's the plan?
Well, the program is designed to help you compound the growth of your money in a tax-free way. So, really what it is designed to do is to sit in a trust account so you can grow that money and pay them off systematically and without paying taxes on the money as you're using it or receiving it. So it's a compounded effect in how we accumulate it, but it really starts with helping people audit how they pay their bills, just like people audit a tax return with an accountant. And we try to teach people how to restructure their bill pay. And then we follow up with them on a regular interval to make sure we're staying disciplined to that goal of getting out of debt.
Now, you mentioned an actuary. Isn't that the guy that deals with my life insurance policy?
Yeah, actuaries deal in a lot of arenas, pension plan estimators. You'll see actuaries in all levels of math and investment portfolio management, but their job is to be able to measure rates of mortality, measure the time value of money and variance. So being able to stress and the scientific approach to math to help people. We do know them in life insurance business because of the mortality tables, but frankly, they're all over the map in mathematics, science, and math for the operations of the government.
Wow. So they're doing a lot of stuff out there that I don't know. Some of us are just, we want to take it. We don't need to know how they do what they do. We just need to understand how we can benefit from what they do. Am I right on, kind of on the right track?
Oh, absolutely. We helped a gentleman out a couple of weeks ago who wanted to retire at 55, and he's 46. And he says, the only way I can do it is if I don't have this debt over here, but I'm not sure how to do it. What was interesting is we helped modify how he was paying his bills and saving for retirement. And he now has a guaranteed lock to retire at 55. And it wasn't because he was going to need to save more. It was because we needed to be more efficient in how we managed the debt.
That's interesting. So Now, so that really hit into that. That's basically what's at nine. Well, my math is pretty good. 9 years, right on, is what you said earlier. So he's going to be able to retire in 9 years, and you basically said he's out of debt. But how does he live then? He must have other savings of some sort to, because at 55, that means he has to basically be planning on 30 years of retirement.
Yeah, 35 years, frankly, and that means he's retiring 5 to 10 years earlier than Social Security payments in his age bracket. So they've got substantial 401ks and they have substantial Roth IRAs. They've been saving along the way. One of them has a pension to help support that at age 60. So they've got ample resources that will compound over the next 9 years, but really truly redirecting monies on his cash flow. So they're not spending any more than they're spending right now, but they literally will be debt free from student loans and mortgage. And the day they retire, they won't need to make more than $1,000 a week to pay all their bills and go on vacation.
Wow. That's pretty amazing. Think about that. Would you like to do that? Would you like to be debt free at 55 and not need more than $1,000? You said a week or a month?
That's what they're looking at. Is their basic paycheck needs is $1,000 a week to live on, plus they come up with vacation money. So it's amazing how far $10,000 a month could go in retirement if you only needed $4,000. But many people have got debt holding them down, and they can't save more for retirement because they're busy paying on debt. And so they're kind of stuck on this treadmill. So we just audit and help people kind of look at things differently. And gratefully, people are just having a great time doing it.
I think it sounds like a great time. If you want to have a great time, take a look at the program, rsrrapidpayoff.com, rsrrapidpayoff.com. And you can take a look at what this looks like. This is an example for a family that went through the program with Todd. And we just kind of lay out some of the numbers of how it could look. Now, these are not your numbers. We need to get you in touch with Todd to figure out your specific. This is just a sample of what other families are doing. You're listening to Ron Siegel Radio, discussing your real estate, current events, and the financial markets. The perks of owning more than one home. There's a lot of people doing that. And we did a story about a week or two ago that people would rather look for a house than a spouse. I don't know that one, but that's a different story. Wondering how to cash out of life insurance and more with Todd Halterman. You can reach me anytime. Our off-air number, 800-306-1990, 800-306-1990, or RonSiegelRadio.com, Facebook.com/Ron Siegel Radio. Then if you miss any part of our broadcast, Ron Siegel 1 on YouTube. Ron Siegel, the numeral 1 on YouTube. Stay tuned. We'll be back in just a few.
Ron Siegel Radio, your home and mortgage connection.
Are you earning a safe, secure 10+% return on your investments? Is your credit score over 800? Are you living in the home of your dreams or simply where you think you can afford? If the answer to any of these questions is no, what are you doing about it? Text ATP to 79564. Complete a 3-minute complimentary survey, and the area trusted professionals of Ron Siegel Radio will reach out to you to develop a success strategy for you. Again, all you need to do is text ATP to 79564.
Are you a veteran, own a home, and need money? The Siegel Lending Team is here to help veterans refinance and get the money they need. The VA 100 lets you borrow up to 100% of your home's value, refinance your mortgages, consolidate credit cards, and lower your payments by an average of $700 a month. And the Siegel Lending Team knows that character means more than a credit score. Call 800-306-1990. That's 800-306-1990. Rate subject to change without notice. Licensed by the California Department of Corporations, NMLS 21037, and DRE number 0186945. We're listening to Ron Siegel's Home and Finance Show with local and national expert Ron Siegel. Now, here's Ron.
Welcome back to Ron Siegel Radio. Within every market, there are solutions as well as tremendous opportunities. You just need some trusted guidance. That is my message, and I will be delivering it every day on Ron Siegel Radio or anytime at 800-306-1990, 800-306-1990. The real-time real estate segment today being brought to you by the area trusted real estate professionals of Ron Siegel Radio. Visit rsrhomedigest.com, rsrhomedigest.com Find out what the county recorder knows about your property, what the market believes about your property. It's a once-a-month email directly to you about your home. The perks of owning more than one home. Many things have changed over the past couple of years, and real estate is no exception. One impact is an increased desire to own more than one home, according to the recent luxury market report from Luxury Home Marketing. As trends such as remote working and flexi hours took hold in 2021, so did the flexibility of relocating as well as the growth of second home ownership. This may be because the pandemic has altered how we think about our homes. Where we live has become more than ever our safe space and our getaway. And with the rise in remote work, more people are reconsidering where they want to live and buying second homes to give them greater flexibility. If you fall into that category, here are a few of the perks you'll enjoy and how owning a second home may be a great decision for your lifestyle and your future. Enjoy a change in scenery or weather. When you have two homes, you can alternate between them as weather changes or as you crave different scenery. Do you want to live in an area with a particular season? Would alternating between a resort and a suburban setting be ideal? With two homes, you have those options, being able to move between homes based on which location best suits you and at the time gives you added flexibility and variety that can help increase your happiness. Build your wealth faster. You may have heard that home equity is skyrocketing thanks to ongoing home price appreciation. CoreLogic reports that the average homeowner gained $56,700. That's a national number, double it for California, in equity over the last year. With home prices projected to continue rising, if you purchase a second home, you could benefit from rising equity on both properties to build your wealth and your net worth even faster. Be closer to loved ones. The pandemic has also reignited the importance of being near our loved ones. One option worth exploring is whether you want your second home to be near the people who matter most in your life. This makes it easier to see your loved ones, but still gives you your own dedicated private space so you can be nearby for major life events or longer visits. Lock in your expenses. Buying a second home today and locking in your mortgage rate may be a good option if you're looking to stabilize your housing costs for the long haul. If you're approaching retirement or are looking to use your second home as your permanent residence in the future, buying that house now with today's rate and price may be a good financial decision. That way, no matter what happens with rates and prices in the years ahead, your monthly payment is locked in for the next 15 to 30 years. Bottom line, having multiple homes has considerable benefits. If owning a second home is something you're interested in, let's chat. Now, remember, a second home is your properties, your homes, other than your primary residence. So what does that mean? Well, we helped a gentleman, our team helped a gentleman who lives in Northern California. He bought he's in Silicon Valley. He bought a second home out in, I think, Yucca Valley, out in the Coachella Valley area. Called and wants to know, can he buy a second home in the Sierra Mountains? Well, the answer is yes, because it makes sense. His primary is near his occupation. He's got a home in the mountains. He's got a home in the desert. He might want to have a home in San Diego, right on the water. If it makes sense, if it's logic to what the second home is, that you're not buying a investment property and calling it a second home, well, we just have to make sure the underwriter, we can put that together for the underwriter and get that information out. That's the Real-Time Real Estate segment brought to you by the area trusted real estate professionals of Ron Siegel Radio. Visit RSR Home Digest, rsrhomedigest.com. Get your report right away. And we got a new group of reports that are going to be coming out probably, I hope, by the end of this week. Our team will have that put together for you. Something we're really, really excited about, because not only will it give you information about your home, you can also do your shopping for the second home right on that same tool. So make sure you continue listening to Ron Siegel Radio, where we've got this information for you. Continue our conversation this morning. Todd Halterman is with us. We're chatting about retirement. You know, and think about that. I mean, 46 years old. Josh, what do you have, about 20 years to get to that one? Give or take? Gonna be retired. Well, I'll be ready to retire before that, but So Josh, 20 years, you'll be ready to retire. What do you think? Is that you might have too much fun gaming at that point, or I don't know, you'd be too soon for you to have grandkids. I probably. I think about the future. That's what I'm kind of getting at, right? So Josh is our millennial. He's my go-to guy for everything and producer on the radio program. And obviously a lot younger than me, but think about these things. If you're a young person listening, 20 years, actually your client that you're just talking about, Todd, is probably 55 years old. How far away are you from that? My son, I got a son that's 23 years old from that, 30 years old from that, or 28, 30, 33 years away from that 55. Gotta have a game plan though, right, Todd? That's the whole idea, is putting together the game plan. I don't know, Todd's on mute here somehow. There we are.
Yeah, the game plan is manage your debt wisely, keep good debt, which creates arbitrage in your life. Mortgage rates are so stinking low, and still they're low compared to historical averages. And to be able to get your finances in order and then have a plan to get them gone in 9 to 10 years is far better than the life average of 23 years for those that are doing the Dave Ramsey plan. 17 to 23 years for those people are running that system and trying to incorporate get out of debt programs there, as opposed to our way with the actuarial support.
So you brought up a good content or comment there. Is there are other gurus or supposed gurus that are out there with different programs on getting out of debt? And a lot of them, their solution for getting out of debt faster kind of means suffering, I think.
Oh,
because you're having to
tighten
increase
up your belt. Absolutely, starve. It's like a diet until you get it gone, and it's painful. And what we've learned is you can teach people how to redirect money on their income and balance sheet, and help them do it differently. But not spend more than they're spending right now, and not have to cinch the belt up where we can't go out once a week.
That's a big issue right there, because I think a lot of people look at it. Why don't we lose weight? Because it's painful, right? We like to eat, we like to drink, we like to go to Super Bowl parties or out for Valentine's Day or celebrate President's Day or Margarita Day or Sweet Potato Day. Right? We like doing all those things. That's enjoyment. Now, here's the issue, Todd, because this is something that nobody wants to ever. It's painful to let to really be honest with people. So when we talk to somebody, we say, okay, you're not going to be able to eat for the next 20 years or 15 years till you get your house paid off. And you got to wait. You can't enjoy a nice car because you got to pay cash for your car. And a car is $30,000 or $40,000. And here's I'm gonna hit you between the eyes. How many people pass away before they ever get to retirement? And they didn't spend their life enjoying their life because they wanted to enjoy their retirement that they never got to. I bet you've come across that in your days of financial planning, haven't you, Todd?
I do. Statistically, 1 in 5 people don't make it to retirement.
1 in 5.
21% of people do not make it to retirement due to disability or death.
That's staggering.
It's a big number,
right? When you think about it. Now I don't want to be morbid, but I want to be honest with you. I want to give you a reality check. And I know that's not necessarily isn't always pleasant. But how many people are in your household? Right? So if you've got a family of 5, mom, dad, and 3 kids, Todd just said 1 is not going to make it to, statistically, 1 is not going to make it to retirement. So part of what Todd is suggesting here is a method or a plan to enjoy life. Right? You're not your program, Todd, doesn't stop life, does it?
No, we really strive to ask people to show us what they're spending every month. And then we try to stay within that really that goal of income and money usability. Again, it's really just how you're using it on a monthly basis. It's not the amount.
So what give me an example. Can you give us a little bit of an example on that, Todd? What do you mean by that? It's not, what
Well,
are you going to do?
In the case of the gentleman who's going to retire at 55, they way over contribute to retirement accounts and to savings accounts, and they're overpaying on student loans. They're overpaying a little bit on a mortgage, and they have one car loan that they're getting ready to be done in about 18 months. So they're paying a little bit ahead on that. But the amount of money that they're putting out to pay extra on these other items, and they're doing it in a non-efficient manner, we simply help them understand why they're over contributing to a retirement account. And sometimes we'll lower those contribution rates and redirect that monies into a bank account for them. We may redirect the extra payment on the credit card to go to the bank and try to help create a systematic, efficient way to accumulate dollars in a fast nature with tax benefits, so that we can use that sum to systematically pay off these debts all at once. So it really isn't just taking the money they're paying on bills. It is looking at the whole picture and helping them redirect inefficient dollars to be more efficient about getting rid of that debt. And that's equally as important for people that become disabled. Ron, 7 out of 10 people become hurt or sick and can't go to work at least 90 days before they're 65.
Wow. So here's the issue. The question I hear from folks when I talk about this with them is, okay, so you're saying that I'm being inefficient with my retirement savings. I shouldn't put as much money into the retirement savings. Okay. Now, that's tax, but that's a tax advantage savings account. So I really want to stop that.
But part of the problem is people don't understand what that tax savings means. And in this case, these people were keeping their average tax rate below 15%. So we were worried more about the dollar tax than the overall tax. And when I measure out the effectiveness of tax now or tax later, that's why the actuaries are here with no emotion to show people how they can redirect those dollars and do it differently. We're not saying people should stop contributing to their retirement so they can get out of debt. I'm just saying there's a difference between efficiencies of how much to put into retirement and how much not to put into retirement, because it's not about asset allocation, Ron. It's sometimes about asset location.
Okay. So what if I put money into a 401k and I've got some of these managed, and most of them, other than the self-directed IRAs, but for the most part, when I put money into a 401k, it's going to be one of the big money managers are going to manage that for us.
Sure.
When we come back, what I want to chat with you about is what kind of return are we going to get on the 401k? Can we expect? And I know there's no guarantees, and we're not looking at that, but I want to look at that versus the cost of interest on credit card debt. When we come back, we're going to talk to Todd Halterman about that. You're listening to Ron Siegel Radio, discussing your real estate current events and the financial markets. We'll also chat a little bit when and how to cash out of life insurance, all that and more. You can reach me anytime. Off-air number 800-306-1990, 800-306-1990, or RonSiegelRadio.com, Facebook.com/Ron Siegel Radio. And if you miss any part of our broadcast, Ron Siegel 1 on YouTube, Ron Siegel, the numeral 1 on YouTube. Stay tuned. We'll be back in just a few.
Ron Siegel Radio. Your home and mortgage connection.
Hey friends, do you dream of mortgage-free home ownership? Are you aware that even if you own your home free and clear, it could still be costing you thousands per year? The Siegel Lending Team can help you generate tax-free income, accumulate family wealth, and maintain ownership of your home. By simply emailing your most recent mortgage statement, you'll receive a no-obligation real estate plan. Learn more by calling 1-800-306-1990 or email me your recent mortgage statement to PEAR@RonSiegelRadio.com. Licensed under NMLS 217037, Equal Housing Lender.
Do you know a homeowner experiencing divorce? Do you know a real estate reference and the divorce decree could cost tens of thousands of dollars? A certified divorce mortgage planning and real estate report could save you thousands of dollars, and it's free from your local certified divorce lending professional. Reach out to Ron today. RonIsMyLender.com. Again, RonIsMyLender.com. Licensed under NMLS 217037, Equal Housing Lender.
Homeowners over the age of 62 are taking back financial control after retirement with reverse mortgages, and the Siegel Lending Team is here to help you use it to your advantage. Call Ron Siegel with Geneva Financial to receive your free information booklet with no obligation. The booklet answers all your questions, and the best part is, you still own your home. Call Ron Siegel at 1-800-306-1990 or visit RonSiegelRadio.com.
You're listening to Ron Siegel's Home and Finance Show with local and national expert Ron Siegel. Now, here's Ron.
Welcome back to Ron Siegel Radio. Within every market, there are solutions, as well as tremendous opportunities. You just need some trusted guidance. That is my message, and I will be delivering it every day on Ron Siegel Radio or anytime at 800-306-1990, 800-306-1990. Your Credit Matters segment today being brought to you by CreditSanitizer.com. You have a credit report, it is wrong. What are you doing about it? When and how to cash out of life insurance. Life insurance designed to provide a death benefit to your loved ones after you pass away. Certain policies can also accumulate cash value that you can tap into during your lifetime. There are different ways to cash out life insurance and various reasons you may want to do so. Before cashing in a life insurance policy, it's important to weigh the pros and cons first. A financial advisor can help you make that decision. Generally, you can cash out life insurance if you have a policy that has accumulated cash value. This can be a permanent life insurance policy or a convertible term life policy. But the idea is the same. There has to be some cash value in the policy for you to be able to withdraw it. Term life insurance generally does not have cash value unless it's converted to permanent insurance at some point. Examples of permanent life insurance include whole life, universal life, variable universal life, and indexed universal life. With universal life insurance policies, the cash value that accumulates as you pay in premiums can also grow by earning interest. The amount of cash value that accumulates can depend on the type of policy involved, how long you have the policy, and how much you've paid in for premiums. The underlying investments can also make a difference in how much interest you earn. Typically, for cash value to be less than what you've paid in for premiums, unless you've had the policy for several decades already. How does cashing out a life insurance policy work? Cashing life insurance simply involves withdrawing some or all of the cash value that's accumulated. There are different ways you can do this depending upon whether you want to keep the policy or not. Main options include surrendering the policy, selling it to a life settlement, taking out a loan against the cash value, withdrawing cash, requesting living benefits, applying cash value to the premiums. There's a lot of different ways, and it's all about your plan. If you want more information on this, give me a call, 800-306-1990, 800-306-1990. Continue our conversation. Todd Halterman is in the house. Before we went to the break, Todd, I was contemplating a concept of what can I expect, just in general. I know that the markets are always going to fluctuate and there's no guarantees, but is there some sort of a number that we can expect as a return on a 401k?
Well, Vanguard just came out with a study on this. It's funny, I was speaking at a conference last week in Carlsbad about this exact topic. And the Vanguard study that I had cited for this presentation, they believe over the next 10 years, the equities market will be averaging somewhere around 5.5% to 6.5% per year. The bond market is going to average between 2 and 4% per year, depending on what type of bond. So that's what Vanguard's expecting. I'm not a way to predict the future, but we've had a heck of a bull run, and We're looking at an environment where interest rates have only one direction to go. The government's got to pay off a lot of the debt that they've paid for. We've got 50,000 people a day turning 65 now, not 10, not 15, but 50. And that snowball is headed for economic issues because more people will be drawing on their 401ks, on their entitlement programs, Social Security and Medicare. That's 50,000 people a day not paying payroll taxes. So Vanguard sees a lot of headwind for growth over the next 10 years in the market. That's why our firms focus on helping Americans get out of debt.
So, okay, so we see that part of it, 5.5 to 6.5. I don't know, say you got a 50-50 allocation. So let's just say 5%. Do we know what the average is for individuals what average credit card debt looks like? How much they're paying for credit card debt?
I don't have that statistic off the tip of my fingers on credit card debt, but unsecured debt today is really never been higher, especially post-COVID. We're also seeing an extraordinary amount of people that went out and bought toys through COVID, recreational vehicles, motorhomes, campers, boats. You can't find new toys right now that people have overbought and borrowed money to do it.
Yeah, that's the whole thing. And so I look at the credit card debt for people. So I get some of that a little bit. So credit card debt, I don't know, we're probably looking at 15%, 20% from various times. I see some as high as 30%. Student loan debt for most people, somewhere in the range of 7 to 8%. So you're putting money into the 401k to earn 5, while you're paying 15 to 30 on other debts.
Well, and you and I both know that any loan that starts out with somebody, the interest amortizes up front. So it may say 7 or 8%, but in the first year or two of that loan, Ron, the bank's really securing 11 to 15%, as you're saying.
So you got a lot. So that's why we go back to the conversation I had at the very top of the program is, what is your blended household interest rate? Right? Look in there, if you go to rsrnodebt.com, that form, it says put in there the amount of your mortgage and the interest rate of your mortgage and your payment. Put in all your car payments, put in all your credit card payments, all your student loan debt. You're going to put all of that in there and figure out, generally when I look at this from people, I'm generally coming up with somewhere around 6.5%, 5.5 to 6.5% is what we see. I think that's about right most often. As we look at 5.5 to 6.5% is the blended household interest rate. So yeah, I know you've got a 3% mortgage or 2.5% mortgage or 3.5% mortgage. Who cares? It's your debt service for your whole house. Now, most of that debt, Todd, you talked earlier, and we should define this a little bit because you went right by it pretty quick. Good debt versus bad debt. What is that?
Well, good debt is debt that you can deduct on your taxes or use to increase your life or blood. So sometimes going into business, you're going to need to borrow a little money to get your business going. And that's just a use of capital. Interest rates on mortgages are so low that people are able to become their own bank. That's acceptable debt in retirement, although we don't like high debt in retirement on mortgages. If we can have at least 50% loan to value, that's where we encourage people to be below that line. So those are the types of debt. Sometimes debt for healthcare issues is unavoidable and better to pay it over payments rather than getting a bunch of money out of your 401k account and paying 30% tax. So it just depends on how you need to use your money, Ron. And that's why we take the audit approach to help families just get a second opinion at no cost from an actuary.
Wait, no cost?
We do not charge for the analysis. It's painful enough to have people actually fill out a form, give us some information. So we feel like if they'll invest the time, which is about an hour of their time, getting things together that we would need to do this audit, then we'll invest an hour of our time putting it into the software for the actuaries to study it.
If you want more information on this, give us a call, 800-306-1990, 800-306-1990. We'll get this information over to Todd Halterman and his team. They'll put together the analysis, set up a consultation with you, see if it makes sense. I don't know if it's going to make sense for you. I have my suspicions. Otherwise, Todd wouldn't be here with us on a regular basis. So far, I haven't seen anybody that it didn't make sense for. So can't deal with your emotional part of this. But from an actuary, from just a raw numbers point, I think you're going to be happy. So give us a call at 800-306-1990, 800-306-1990. And as always, I ask you, set that first radio preset button to come back here and join Ron Siegel Radio, where we only speak about items affecting your house and your bank account. Thanks to all of our sponsors. A very special thanks to Josh and Sean who are engineering us today. And, of course, a special thanks to you for spending a little bit of your day with us. That's all for Ron Siegel Radio. Again, if you have any questions or to meet any of our guests, call me anytime, 800-306-1990, 800-306-1990, or ronsiegelradio.com. And remember, make a lot of money so you can help a lot of people and have a lot of fun. Have a great day. We'll talk to you next time on Ron Siegel Radio.